Hello and welcome. In this lecture video, I'll be talking about the financing activities section of the statement of cash flows. Just like investing activities, the reporting on financing activities is identical under both direct and indirect. And again, that term direct versus indirect methods refers only to the operating activities section of the statement of cash flows. Okay. So when we're talking about financing activities, remember that what we're talking about are those transactions that affect long-term, non-current liabilities and affect the equity portion of the balance sheet. Okay, so examples would be issuing bonds, paying bonds, retiring notes payable. Okay, paying dividends is another example of a financing activity. And so when we look at our example for our Genesis company, which is what we've been looking at for a while, here's our financing activities. Received $15,000 cash from issuing stock. That affects the equity section of the balance sheet, so that's financing. Paid money to retire notes. This is also financing. Notes payable, long-term notes payable, financing. And declared and paid cash dividends. This hits the equity section of the balance sheet, also financing. Okay, so what we're going to do next is we're going to do the journal entries for each one of these transactions, and then also look at how these journal entries affect the T accounts for our long-term liabilities, our long-term notes payable, and then also our retained earnings and our stock. Okay, so first, we'll come over here and let's look at the first one, which is notes payable. So remember, if we look over here at the top of page 64, it says paid $18,000 to retire our notes payable, yielding a $16,000 gain. Okay, so what is the journal entry to do this? We'll come over here and we're going to say debit to our notes payable, because our notes payable is a liability and we're paying that off. Okay, so we debit that for our $34,000, which is value of those notes. The outstanding balance on those notes payable is $34,000. And then we're going to pay $18,000 cash. So we credit cash for $18,000. And then we yield a gain of $16,000, which is the difference between the outstanding balance and then how much cash we had to pay to retire those notes. So that gives us a gain. I'm just going to write gain, but it would be really called, I'm just running out of room, but it would be gain on retirement of debt. Just going to say gain for now. That's at $16,000. What is our net cash inflow or outflow for retiring this note payable? It's the credit to cash right there. How much cash we had to pay. So whenever I say this net cash inflow for retiring this or for issuing stock, I'm saying, well, what is the increase or decrease in cash? Well, it's a decrease of $18,000 because we paid $18,000 cash right there. Okay, so now I'm going to hit pause and I'm going to flip the page. As I was saying, I flipped the page over and I'm going to show you the T account for notes payable and how that journal entry affects the beginning and ending balances for notes payable. Okay, how do we get from $64,000 to $90,000? Well, if you look over here on your notes payable, it's hard to see, but if you look on your page in your notes, you got $64,000 beginning, $90,000 ending. It's on the credit side because it's a liability. Now remember, what we did under investing is we purchased $70,000 in plant assets by paying $10,000 cash, but also issuing a new notes payable. So that's that credit to notes payable that we pulled actually from the investing activities. And then with this journal entry, what we just did was debit our $34,000 for our retired notes payable. $64,000 plus the 60 minus the 34 gives us the $90,000 ending balance right there. Okay, so let's look at the next one, which is our common stock. So it says right over here, as we saw on this page, received $15,000 cash from issuing common stock. Okay, so look at that journal entry. That's what we're going to do now. And to do that journal entry, we debit cash for $15,000, and then we credit common stock for $15,000. So what is the net cash inflow or outflow from issuing stock? Well, it's $15,000 right there. That's the debit to cash. There's no other credit to cash for this journal entry. So it's simply that $15,000, okay? So let's go ahead and look at I'm going to pause the lecture video, turn the page over, and look at the T account for common stock, okay? Okay, so here's our T account for common stock. We have $80,000 beginning, and where do we get that? Look over here, $80,000. Again, it's kind of hard to see. $80,000 beginning, $95,000 ending. How do we get to that number? Because we issued $15,000 of stock, and we just did that journal entry. So the beginning plus the 15. So saying the beginning plus the issued gives us the 95,000 ending. And let me point that to you on the correct spot. On the other second ago, I pointed you to the wrong spot. Here's our common stock, 80,000. It's kind of hard to see, but if you look in your course pack, you can see it better. And then $95,000 ending. That 80 plus the 15 gives us the $95,000 right there for common stock, okay? All right, so I'm going to pause the lecture video and then come back. Hello and welcome. So welcome back here. We have our final transaction that we need to deal with, where we said we declared and paid cash dividends of $14,000. And the journal entry to do that is debit retained earnings, $14,000, and then credit to cash for $14,000. In terms of what is the cash flow effect, well, it's that we paid $14,000. I'll represent the cash outflow in parentheses, cash inflow, no parentheses, cash outflow. Okay, so let's take a second. I'm going to turn the page back over, and I'm going to do one final T account to show you the beginning, how we got from beginning retained earnings to the ending retained earnings, beginning balance and retained earnings to the ending balance and retained earnings. Okay, so let's take a look. So it's a little hard to see here, but if you're on this page, if you go back to this page in your course pack, you have retained earnings beginning of $88,000 beginning, and then retained earnings ending of $112,000. How did we get from 88 to 112? That's what I want to review. Well, we have our 88,000, it's credit balance and retained earnings because it's an equity account. And then remember, net income is closed out to retained earnings through the close process. So we have the net income of $38,000. And where did I get that from? My income statement right there, $38,000. So I credit retained earnings from my net income during the close process. And then I paid that $14,000 retained earnings. That was the journal entry we just talked about. Debit to retained earnings, $14,000. Credit cash, $14,000. 88 plus the 38 minus the 14 gives us the 112, which is our ending balance right there in retained earnings, okay? So now what we can do is we can go on to the next page and look at the total net cash inflow, outflow for retained earnings. So you can say cash from issuing stock, $15,000, right? And we could say cash paid to retire notes, $18,000. And we can say cash paid for dividends are $14,000. Cash outflows, cash inflow. And then what I can say is net cash used by financing activities. And the way I get that is I take my 15,000 minus 18 minus another 14, and that gives me a net cash outflow of $17,000. And that's why I say net cash used, not net cash provided by financing activities. Okay? So that concludes this lecture video covering the financing activities. The next lecture video will cover some additional quick check problems on investing and financing. Thanks so much.